Hello everyone and welcome to the first part of the five-part webinar series on using technical analysis from a practitioner standpoint. Thanks to the CMT Association for giving me this opportunity. So in this webinar series, we actually will be discussing on how one can put theory into practice and generate actionable trading ideas. So I'll be sharing my perspective on how you can use technical analysis to identify trades and convert them into money. So just to give you a brief overview of the topics that I'll be covering in the subsequent sessions. Firstly, I'll be taking you through a quick refresh of some of the basic concepts of technical analysis and what are the key things that we need to keep in mind. Then I'll be discussing about how or what are the things that are required in terms of trend identification, and in particular I'll be sharing my perspective on using trend lines to identify directional biases in any asset class or stocks. So then in the subsequent sessions I'll talk about how exactly one can identify trades using pattern analysis. Then this will be followed by a session on few indicators and market sentiment. And finally, we will be looking at how we can combine all of the concepts that we would have learned into mix of ideas and really start trading. So in this webinar, the idea is basically not to discuss all the technical tools available in the arsenal of technical analysis, but the idea is to master some of the concepts which can yield results for you. So by the end of the whole series, we hope that you will be able to approach the markets more confidently and really start to think like a professional trader. So before I proceed any further, let me introduce myself. My name is Prasenjit Biswas. I am a CMT CFTE charter holder, and I have about 15 years of experience in this industry. And presently, I am working for one of the largest brokerage houses in India, on the sell side research. Right. So without much ado, let's begin with today's session. So we'll look at some of the core concepts of technical analysis. So basically, there are various types of charts that we all are aware of: line charts, bar charts, candles, and Heiken-Ashi point indicator and market profile, so on and so forth. So we all are aware of these charts. So the point here that I'm trying to make is that basically what is the importance of charts? Why actually do we look at charts? I mean, is it absolutely necessary in technical analysis to look at the charts, or is there something more to it? So basically, if I just show you this price data, which is there on the left side of your screen, so it's like a series of dates and you have prices. Now, if I ask you what is the inference from this data, it would be slightly difficult for you to understand only by looking at that price sequence. But then on the right side, if you see the graphical representation of the same data, it becomes more visually appealing and easier to interpret what has happened in that series of data. So this is what is the point, that basically charts are not like an essential necessity of technical analysis. So technical analysis is not only about charts. So there are like methods which are pretty much model based or mechanical in nature, and which is mathematical in nature. So there you don't really need any charts, right? So in case of your method, which is like visual in nature, so it is up to the user. If the method in itself is visual in nature, then obviously we would need charts, and they are just for our convenience and for better visual inspection. So this is what we have to keep in mind. And then there are two types of charts in terms of how we can plot the data in terms of the scales. So one is linear and the log. We are aware of this. So the basic difference between log and a linear is, as we know, that in a linear chart, the price differences in the y-axis are equal in amount, and they are represented as a actual difference or an absolute difference of the prices or the price points. And On the other side, when we look at a log chart, basically the differentials are expressed in terms of a percentage. So this is what we are already aware. But now, if you ask me what is the implication or the difference in terms of their implications, so here is an example. Like there is a channel sort of a formation, as you can see on the left side of the chart. It's basically a parallel channel which is rising. And if I just simply flip this to a log chart, it would actually look like a rising wedge. So, however, the implications are same. That is, you go short below the breach of the lower trend line. However, the difference is in the implication. Generally, a rising channel does not necessarily imply a change of reversal or topping formation. But then, when it comes to a rising wedge, certainly they are more potent formations, and they often end up into a complete reversal of the price structure. So this is what is the difference. So similarly, if you convert like a kind of a falling wedge, which is there on a linear chart, falling wedge on a linear chart would turn into a kind of a channel, a parallel falling channel on a log chart. So these are the slight differences that we just have to keep in mind when we going forward would be looking at different time scale charts. So now comes the main part of the presentation, which is regarding trend identification. So when we talk about trend identification, there are actually quite a few schools of thoughts, various schools of thoughts in the technical arsenal. Basically, there are a lot of indicators like moving averages, oscillators, bands, Ichimokus, so on and so forth. Then there are pattern techniques, which are like triangles, channels, and all of that. And then we have Japanese techniques also. So where the practitioner of the Japanese candlesticks would look for certain candlestick patterns to draw inferences regarding the prevailing trend. And then again we have elitations. As elitations, they look at the price structure in terms of wave principles, and using the concepts of Elliott wave, they try to ascertain the length of the move and the quantum of the reversal or any sort of continuation rally that is likely to happen. So the list goes on like this, and there are various schools of thoughts, as I said. So not really any of the method would be superior than the other one. So that would not be the right thing to say. But then the point is, what is the single most concept, if you were to ask me, which is very effective in nature and which could be learned very easily and implemented to a greater extent with the ease of the usability and the user friendliness. So now if I have to draw a comparison between a trend line and a moving average, I would simply say a moving average is like a rope, and a trend line is simply like a stick, which is very rigid. So if you were to look at the behavioral aspects of a moving average, you would realize that they are quite flexible in nature, and they can turn and twist with the changing price dynamics. However, the trend lines, they are very rigid in nature. However, both the tools fall under the category of trend lines, because as we are aware that moving averages are quite widely used as a form of trend identifier, and often some of the combinations of moving averages have been used or are being used to identify trend change points. So what is the definition basically of a trend line? So to me, basically a trend line is like a line which can demarcate or can differentiate between an uptrend or a downtrend, and it is a line on which if I put my finger, I would be able to come to a particular level below which or above which I will be able to say that, okay, the trend is now reversing. So essentially a trend line is nothing but a broad structure or a line which can simply tell me a number, a singular number, below which I will assume that the trend is going to reverse, or below above which the trend is going to remain in force. Right. So now this is what probably most of you are already aware of. Now again, coming to the basics, some of the things that we must keep in mind when it comes to trend lines. These are pretty basic in nature. However, I'll just take a couple of minutes to take you through very quickly. So as we know that in an uptrend, basically the sequence is of a higher high and a higher low. So especially the uptrend is defined by the sequence of higher lows. And when you connect those higher lows, you form kind of a trend line, which tells you about the pace and the speed with which the trend is moving. So similarly, in the case of a downtrend, you connect the highs, which are lower in nature, a sequence of lower highs one after another, and that's what will give us the trend reversal point, or below which the trend is assumed to be in downtrend. Now, what is important here to remember is that for any trend line to be drawn, or for that matter, any line to be drawn, geometrically, we basically need only 2 points. So similarly, in trend lines, again, we will need 2 highs or 2 lows to be able to draw a trend line. And the potency of the trend line would depend on certain factors like the length of the trend line and the number of points that is there on the trend line. And again, a very interesting aspect is the spacing. So when you are joining the dots or the highs or the lows in an uptrend or a downtrend, we have to look at the symmetry of the points as well. So what I mean by symmetry is that if the spacing of the points is not equidistant or not in sync with each other, kind of, if they are really widespread and randomly spread, then maybe the potency of the trend line would not be that great. But on the other side, if in case the spacing between the points are well matched and they are in sync with each other, then I would say that the potency of the trend line is going to be higher. And again, the angle, as we know, that if a trend line is too steep, the potency of the trend line would not be that great. Because imagine a trend line which is like a 60-degree trend line, then obviously, if the prices just drift sideways for a couple of days, then there would be a default breakout or a breakdown from the trend line, and which really doesn't mean anything. So because that's going to be like a by default breakout or a breakdown. So the angle is important. So ideally, anything which is like 45 degrees to about flat, completely horizontal. So what has been my experience is that those kind of trend lines have a lot more potency, because they really depict the underlying psychology of the market participants, and they are able to kind of tap what is going inside the stock in terms of the psychology. Right. So up till this point, probably we all are aware. And again, when it comes to drawing a trend line, like in an ideal case, what happens is that you would probably find, if there is an uptrend, then probably you would find all these points 1, 2, and 3. They all are lying in a very straight line. But what happens is, this is an ideal case. This is theory. And in reality, you don't kind of find these sort of nice structures in place. But what you encounter is misaligned cases, where probably the points that 1, 2, and 3 are not in a straight line, so they don't quite fit in nicely. So how do you exactly draw the trend lines in such cases? So here, just I am going to share my perspective to deal with these practical problems that I have understood myself, or kind of realized myself what works best. So let's look at the first case here. And sorry, I'll just take the marker. Okay, so yeah. Okay, so if you are looking at this particular trend line, and this is the point number 1, this is point number 2, and point number 3. So as we can see, these 3 points are not kind of really aligned to each other. So how exactly do you draw a trend line to find the support in this particular stock. So there are actually three possible scenarios. You can connect trend line 1 and 2. So you get trend line 1 and 2. You can connect 1 and 3 and you still get a trend line. And you can also connect the last 2 points, which is point number 2 and 3, to get a trend line 2 and 3. So out of these three possible combinations, we look at individually and we will try to figure out logically which is the best trend line, and whatever principles of technical analysis are there, and whatever we have learned. So based on that, we will try to logically deduce what is the best trend line. So now if you look at the first trend line, which is the trend line joining 1 and 2. So in this particular case, what happens is, if you would connect the first and second dot, if you connect these 2 points, then you see that there is a breach at this point. And really after that, there was a breakdown in the stock and it made a low of 3. So now if you would remain with this particular trend line, which is 1 and 2, then the potency, I mean, the validity of the trend line is not there anymore, because it really is not any support as of now, because the prices have moved up from this point. However, it could have acted as a resistance, but then that's a different story. So in case if you're looking for a support line, then this 1 and 2 is not really the one which is going to act as a support. So this is out of the window. Now, if you choose 2 and 3, this can work. This can really work. I mean, you can just simply connect the dots of these 2 lows and you can still get a trend line. But then there's nothing wrong in it, if you ask me. But then the point is that in this particular case, you are going to take only the points 1 and 2. You are not actually taking this first point, which is the initial point. Now, in comparison to 2 and 3, if we consider the trend line joining the points 1 and 3, so let's see what happens. So in this case, we get the blue colored line. So this is the one I'm talking about. So in this case, if you will see, it not only takes care of 3 points, because it is taking care of 1, it is nicely taking care of 3. I mean, we have connected 1 and 3, and then the point number 2 is above this trend line. Now, the idea of a trend line is to actually take care of all the points which should lie above the trend line. So as long as all the lows which are above trend line, so that kind of holds the validity, or kind of emphasizes on the validity of the trend line. So as long as your points are above the trend line and they are not really puncturing through, so the validity of the trend line would be there. So in this particular case, compared to the trend line 2 and 3, I am taking 3 points. So 1, 2, and 3. So this point number 2 is also taken care of, although there is a slight gap between the trend line and the price point. But then that's okay, because as long as it remains above it, we can consider this to be a valid trend line. On the other side, if you were only to look at this particular trend line joining 2 and 3, it can still work. But then there is one more issue, that is, it is actually going to be, at a much lower level. So in case going forward, if there is a breakdown, obviously your point number trend line joining 2 and 3 is going to be at a much lower level, because this line joining 1 and 3 is kind of more rising in nature, and it can give me an early indication of a trend reversal. Whereas if I am looking at the trend line joining 2 and 3, I would not be getting any sign of a weakness before this point. So there is always going to be this kind of a gap, and the trend line which is slightly ascending in nature, which is more inclined in nature, would always give me an early exit or an shorting opportunity. So I personally prefer the trend line joining 1 and 3 in this sort of a situation where the second point is not really touching the, I mean, it's not like working out. So 2 and 3 is fine theoretically, but then I think 1 and 3 works better because of this particular reason, as I mentioned, that you get an early exit out here. So if you can enter a trade before the others can, then you have that extra edge. So that's where the edge is created. And theoretically, as long as it follows or it fulfills the criteria of other principles of technical analysis, I think 1 and 3 should work good. Now, if you look at this, the other situation wherein the point number 3 is actually above the line joining 1 and 2. So in this particular case, if you continue with point number 1 and 2, you still get a trend line like this, the lower one. But then in this case, this 1 and 2 is possible. No, it's not possible. So if you are joining this 1 and 3, if you are joining this 1 and 3, it's not a viable trend line, because in this particular case, the trend line joining 1 and 3 has a violation here, which is the point number 2, which is penetrating this trend line. So it cannot be taken as a valid trend line. So the possibility of the line joining 1 and 3 is negative, and this is not an option. So what we are left out with is the combination of 2 and 3, combination of 1 and 2. So when we look at the combination of 1 and 2, in this case, the trend line is running slightly behind. It's kind of going to be late in case there is a reversal of the trend. However, both the trend lines are joining only 2 dots. There is no concept of taking care of the point. But then in this particular case, if we take the trend line 2 and 3, this is kind of much more early in nature, I would say. It is more faster in nature, and in case if there is a breakdown going forward in time, then we will be able to identify the reversal much early in comparison to the trend line 1 and 2. And again, at the same point of time, let's say if this goes up from here and this trend line runs across like this, and this 1 and 2 goes like this, obviously this is going to be much earlier. You can visualize the difference that you can have. So in this particular trend line, which is running 2 and 3, would have given you a very early exit, and in comparison to that, you would not have acted on this point number 1, 2 trend line, which is here. So up till this point, you won't have really acted on this, or probably you won't have gone short, or either you must be probably you would have remained long. And the other thing is that if you look at this closely, the distance between the 1 and 2, like we talked about the spacing concept, so the distance between 1 and 2 and then 2 and 3 looks even. And when there is a breakdown, ideally the breakdown should also happen at a very similar spacing, so that the concept of symmetry is there. But if we consider this 1 and 2 trend line, then the first distance between 1 and 2 is this much, and when the breakdown would have happened at this point, the spacing would not have been in sync. So the spacing would have been quite wide in comparison to what it was in 1 and 2. So ideally, in this sort of a situation also, if you follow the principles of the symmetry, then the breakdown at 2 and 3 would again be questionable. I mean, I really would not be having much clarity in terms of whether I should go short here or not. So these are the few things that I thought that I should mention when it comes to trend lines. Now, as you can see, I'm taking only the basic cases wherein I am considering only charts. I'm not looking at the intraday highs and the lows. And so the idea here is to convey the basic concept of how you should deal with such situations. And when it comes to the intraday high lows, we will of course learn them. We will see some practical examples which I'll be sharing during the course of the presentations. Now let's go to the next slide. And right, so now coming to the next few points that are important when it comes to drawing trend lines, is that obviously, as we know, that these trend lines are being used to draw patterns, and patterns are nothing but essentially symmetrical shape, which is where we find 2 trend lines, one on the lower side and one on the higher side. So there is a support line and a resistance line, and for that we would actually need 4 points. So the lower points can give us the support line, and the higher 2 points would be giving us the resistance line. Now, what is important here is to understand that when we are talking about this particular point number 4 here, Let's say if there is a situation wherein a stock goes up and makes a high at this particular point number 1, and then it goes down to point number 2, which is like a correction, and then there is again a rally back to the point number 3. So you have a sequence of 1, 2, and 3, and now once again there is a sell-off in the stock, and the stock goes down all the way back to point number 4. So at this point, can you really say that this is the point number 4? Take a couple of seconds and just try to understand what is happening here. So can I really call this as a point number 4 or a support point? Not really. So the reason behind this is that basically you cannot call a point as a support or a resistance point unless there is a meaningful reversal from that point. So at this juncture, the prices have not really reversed. They have just shown one small uptick. So with this small uptick only, you cannot really determine whether the stock is reversing, because going forward this could happen. So eventually the stock could actually not really take any sub from here, and this could end up into a minor glitch, and the stock actually could just continue the whole downtrend itself. So at this juncture, we cannot really call this as a reversal point. So unless and until there is a meaningful reversal, we really cannot call this a reversal. So what we should be looking for is this sort of a bounce back. So only after this particular point we can say that, okay, this is the point number 4. And up till this point, up till this happened, we would not have been able to say that there is a reversal and there is this point number 4 in place. So after this particular bounce, we have those 1, 2, and 3, and 4 points in place. Now the other thing is that when it comes to the breakout, just try to remember the thing that normally the breakouts should be found in the direction of the trend joining the points 1 and 3. So here, if the highs are like point number 1 and 3, if these are the 2 points which are forming the highest points, then in this case this would be the breakout point. So the breakout is happening in the direction of the trend line joining 1 and 3. Now if you will say that, what if the prices would come down from here, then I would say that the point count change. So this 2 will become 1, and this 3 will become 2, and 4 will become rather 3, and you have the 4th point here, which is the high. So again, your sequence of the points will change. So the counts will change. It is as simple as that. So again, you will have a breakdown in the direction of the trend line joining 1 and 3. So which will be the lower case. So this principle will help you to avoid mistakes when you are trying to trade patterns. So this is a very basic principle that I follow, and this has worked for me. And the next thing that we have to keep in mind is the fact that the points have to be alternating in nature. So as we know that there has to be 2 highs and 2 lows. So now if the highs and the lows are not alternating in nature, like in this particular case, which is there on the screen, so we can not really identify any pattern. Although we are kind of, our human minds are in tune to find patterns where there are none, but then this is where the pitfall is. So actually, if you ask me what is the interpretation of this, I would say that the points 2 and 3, they are all valid bottoms, but then this is not an alternating pattern, because the points 1 and 4 are the highs, and 2 and 3 both are the lows. So ideally 1, 2, 3, 4 should be a sequence of high, low, low, high, like that. So it cannot be a sequence of, you know, highs and then lows and lows. So they have to be really alternating in nature. So this is one of the, again, principles which is very effective when it comes to pattern trading. And with this, basically, I will come to the practical application part, and we will look at the trends in real life charts and try to understand them in a much better way. So I'll just flip my screen into the chart section, And here we will look at some charts which will give us a better understanding. Now, this is a chart for a particular stock called Muthoot Finance, and as we can see that if we remember the principles that I discussed just now regarding the spacing and the slope and the number of points, so it's a very easy trend line to be spotted, because here it's like a downtrend which is connecting the highs, which are lower highs, a sequence of lower highs. And here, if I'm just trying to draw a particular trend line, I'm going to connect all the highs which are there. So in this case, I am not taking the closing line chart, because if I take the line chart, it would look like this. But then you should ideally refer to both the charts in terms of the line chart and in terms of the candle or the bar chart. So both these charts should be looked at parallelly. So if we would have looked at from the line chart perspective, this is how I would have probably drawn the trend line. So that this line would have been probably the second trend line. So ideally, when you see a breakout, or when you are trying to identify a trend, try and look at both the charts, not only the candle charts or the bar charts, also try to refer to the line charts as well. And there would be a lot of situations wherein you would find that there is a breakout on the candle chart, but then it really did not happen, because the closing was not above the trend line. And on a closing basis, if you have flipped to the line chart, you would have found that there was actually no breakout. And there is this other situation also, wherein the breakout would have happened much earlier on the line chart, and eventually a breakout would be followed on the bar chart or the candle chart as well. So in case you're trying to identify trend lines, my suggestion is that one must look at both the charts and try to figure out what is the trend. And in case if you are able to see a breakout on the candle chart, then also make sure that there's a breakout on the line chart as well. Like in this case, if there was a breakout above the upper line, which is like the line chart or the bar chart, I'm also cross-referring this, and I'm also looking at if there is a similar story based on the closing prices too. So the difference between the line chart and the candle chart in terms of the psychological perspective is that a line chart kind of gives us a consolidated price. So since it is based on the closing prices, it kind of eliminates a lot of noise, and it brings some more clarity in terms of the underlying activity in the stock. Because if you look at a bar chart or a Japanese candlestick chart, a lot of intraday activity can influence the shape of the candle or the height of the bar itself. So which is where we don't want to get into if you are looking for a positional trade. So if there is a breakout probably based on a line chart as well as a candlestick chart, then that breakout is much more valid in my opinion, and more stronger in my opinion. So in this case, as we can see, subsequent to this breakout, there was a price drift which kept the stock afloat. And I'll take you through more examples, and let's look at Colgate. And in this, I would want you to identify as a trend line, a support trend line or a resistance trend line. So you can take a couple of seconds here and see if you can figure this out. Okay, so congratulations to those who have been able to identify the support trend line. And I'm going to be drawing this trend line for you here. So the support trend line is, in this case, is like this. So once there was a breakdown from this particular support trend line, there was a shorting opportunity in the stock. So this is kind of joining the candle lows, and I'm going to go short at this particular breakdown. Now, if we would have looked at the line chart, this again would have told us the same story. So again, here, if you would have joined the lows based on the closing prices, you would have still got a very similar kind of a trend line, which would have been like this orange colored trend line. And if you look at the difference, then obviously there was a very early indication at these particular levels, wherein the indication was that the trend is becoming weaker. So eventually, what happened to the stock is what we can see on the screen. So these are the things that I'm trying to highlight, that always try to look at both the line charts and the candlestick charts both. So now the natural question that would be coming to your mind is, where do we short exactly? Do we short or buy or act upon once there is a breakout or a breakdown based on the closing line charts, or do we really wait for the candlestick chart to give a breakout or the breakdown? My opinion is that it is better to wait for the candlestick charts actually, because what happens is that there would be a lot of situations where might be uh, you might not get an indication even on a closing chart. So it is not necessary that on a closing chart you would actually always get a clear signal, because just imagine a situation wherein a stock would just keep on oscillating between say 100 and 110 on an intraday basis, and then by the end of the day, if it every day closes at 105, so your line chart would have looked like a flat one, but then the range would be there. So in case there is a breakout above 110 or 100 on the lower side, then automatically that would mean something that would automatically indicate a disbalance in the equilibrium. So the idea is that always cross verify. It is better that if you get a confirmation on the closing charts, but then line chart is what I will act upon. Now, taking few more examples, I'll pick up DMart, and let's say what is the big trend line here. So these are all daily charts, and as we can see in terms of the spacing, so this is a starting resistance line, this is the second supply zone, and then this was a third supply zone which actually did not touch this line chart here. So I could have drawn a line connecting 1 and 2, and that would have given me this resistance line, and the alternating combination could have been like this, so wherein I'm joining this particular point and the next high, which is this one. So I would have got this second trend line as well. So out of this, basically I would have personally acted upon this green trend line as well, but then it is important to be aware of the other possibilities that other people may be looking at. So from the principles that I just mentioned, eventually the breakout did play well. But then since there was an overhead trend line right above this green line, so it can at times happen that the stock may not immediately shoot up. So the idea is that if there are clear skies, if there is no state of confusion as to how you should be drawing the trend line, or if there is a clear trend line, then the breach of the same would really catapult the stock, or there would be a quick move in the stock. But then in case there is a confusion regarding the trend line or as to how you should be drawing the trend line, then you have two options: either skip it completely, don't have to trade. It is not important for you to comment or have an opinion on each and every stock. If you do not have clarity, skip to the next stock. Or else, if you still want to trade, then you can obviously cross verify using line charts, and you can always use the other tools to cross confirm whether you want to act on that trend line or not, or which trend line you should be looking at. So on a closing basis, this is going to be like this. So this is the third reference I'm trying to look at, which is what probably bring in more clarity to me. So maybe I'll use this black color for this trend line. So now if I look at this, so this black colored line is the one which is actually bringing much more clarity, right? Because when I was looking at this only red line, it was okay, but then the point was that I was skipping this point number 3. So the green line was the other option where I would have kind of been able to draw the trend line using the point number, this second point and the third point. But then the issue was that if you are not aware of the line charts, so that is always going to create that confusion. So this is what I do, basically cross verify using line charts. Now let's look at some more charts. So I'll pick up escorts. So in escorts, as you can see, it is not very difficult. It's a very straightforward line. You have the high here, and the next high is a lower high. So by joining the peaks, you can get a very clear resistance trend line. And similarly, on the downside, this was a support cluster followed by this particular spike low, and which happened to be like falling near the third low as well. So here, if you were to talk about the sequence, this would be my point number one, and then this would be point number two, and so this is one, this is two, and this would we will be looking at as point number three. So this would be point number four. So the breakout happened in the direction of the trend line joining 1 and 3. So this is where the breakout happened really. So this is the principle that I was talking about. Okay, so now if we look at some more charts, I'll pull more charts for you. Let's say we pick Ramco Cement. So again, in Ramco Cement, as you can see, the trend lines could be drawn like this. I'm just connecting the highs, and these lows are going to be the first support or the first reversal point, and the second reversal point was more or less at the same level. So this is kind of giving me the support level. So at this point, I would not have been able to this particular draw this particular lower support line. It was only after there was a meaningful bounce till this point I was able to actually draw this support trend line. So when the stock fell from here, I had this particular point number one. This was one, and then when it bounced off from here to here, I got this particular point number two. And then again, when it fell from here to this point, I got this as point number three. And it was only when there was a small tick, I wouldn't have been able to call this as a four, because the prices could have gone down. But then when the prices would have probably rallied to this particular point, then this is the point maybe wherein I can say, okay, this is the point number four, and I have this support line in place. So I have this 1, 2, 3 as a sequence of alternating supports and resistances, and the moment there was a breakout above the trend line joining 1 and 3, as you can see, there was a quick move after that. So now let's pull okay, say Mahindra and Mahindra Finance. I'll pull Mahindra and Mahindra Finance. Okay, so yeah, so again, in this particular chart, I want you to identify some trend line or some trade setup. Well, yes, there are quite a few. Basically, this was one of the resistance areas that you can see. This is one, and then this was the other one. So if we draw these lines properly, then we will be able to kind of identify them. So first, I will just try to draw this particular resistance line. So I will just connect this point and then look at this point and then see where it goes. So since in this particular case, this point number 1, 2, and 3, they are kind of more or less falling exactly at the same straight line. So there is no confusion. So this is kind of a nice resistance line. And in terms of the distancing also, if you would look at, then the distance between the points are pretty much evenly spaced. They are not completely out of sync. And therefore, once this line was broken, we can see quite a nice move after this. And if we flip onto the line chart, then a similar story would have been there. We would have been looking at something like this. This is the point first, this is the second point, and then this would be your third point. So you would have got a trend line like this, the black color trend line. And when there was a breakout at this particular point, or maybe the next day here, so this was the point to be acted upon. And in this particular congestion area, if we are not able to clearly identify a very clear support or a resistance, then maybe we can actually look at the line chart. So broadly, it's not a very clear setup though. But then what happened here was that on a line chart there was a base at these levels. So it kind of gave an indication of a breakdown initially when it broke here at this particular point. But then the stock actually reversed from these lows, which was in line with the low which is in spike at this particular point. And eventually on the higher side, when it clearly went past through these resistance areas, the big move really took off.
Now I'll just pull one more chart for you. This is of Maruti daily chart, and I'm just trying to draw a trend line here. So I'll just pick up the red color from the color palette, and I'm just trying to get the trend line here.
In terms of the symmetry, this is the starting point, and then you have a point here, and then the next point is here, and then the fourth point is here. So if you look at the spacing, it is more or less very much in sync. So when it comes to actionable trades, maybe you could have gone short on Maruti at this particular point. So this is where the breakdown was. And if you flip to the line charts, it also kind of gave a very similar story as well. So in the line charts also, the breakdown at this particular point was quite evident, and this was a point probably where one should have acted. And one more chart where I will show how like a trend line which is drawn, which is not really something which I would call as a valid trend line. Now in this particular case, I'm trying to draw a trend line using these lows. So this is the low, and there are quite a few sequence of lows here, a bunch of lows which apparently look like that they are going to act as a they have acted as a support, and then this particular point. So if I would have just simply drawn a trend line like this, then it looks kind of okay to me. But then there is a flaw in this particular trend line. The flaw is that when you are drawing a trend line which is based on points which are not really separated from the trend line. So in this particular zone, if you would see that most of the points at this particular point have all like glided on the trend line itself. So they have not really kind of bounced off from the trend line. So this was, let's say, a low, and then this was a high. And if in case if you are able to see like a move like this on the trend line, so it really doesn't make any sense. Ideally there should be a move up. So this is what actually is required, that there has to be a move up in the opposite direction, and that is the only way to identify that if support is valid or not. So here the whole idea is that to find a low, but what low do you take, which low do you take? There are so many lows, so it really did not kind of I would say it doesn't qualify as a real low in nature. So although you can live with this trend line, but then probably I won't have acted or taken any trade based on this particular trend line, because to me it doesn't look like a proper trend line. However, when the stock was trading from here, maybe I would have drawn something like this, a trend line from here running across, and maybe if there was a breakdown at this particular point, maybe there would have been a trade. So if I exactly draw the trend lines here, then it would look like something like this. Maybe I'm taking this particular low and then this low, and I would have left this particular trend line. So maybe this gap and this gap and this gap. So if we, even if we ignore this particular point, this particular point is where the trend line is getting validated. Now what is here interesting is that at this particular point, the breakdown is not in sync. Like if you connect this particular point and then look at this particular point, they are quite separated, very much wide compared to the this one and this one. So the next point is this, and the breakdown point is this. So the point at which the breakdown is happening and the spacing is not quite uniform in nature. So this is where the symmetry thing goes for a toss. So this is what I was discussing about. So these are the things which probably, if you keep in mind, can help you avoid certain bad trades. So this is basically an example of how you can easily fall into a trap, and I'll show you one more example of this Marico, uh, wherein again something very similar happened. Uh, so here, as we can see, there would be a high, which is a proper high because our prices would have fallen after that. So I'm starting this, and then this is the second high, and by joining these 2 points I'm getting this red color resistance line. But then if you see, after this line broke out, ideally the prices should have gone up, but then that did not really happen, and the stocks was kind of moving sideways in this tight range, which was just back and forth above a trend line. So what I'm trying to say is that trend lines are just one of the tools that you can use. So it is a probability, it is not a certainty. So it can happen that a trend line might be broken, and a kind of indication of a trend reversal or a continuation could be seen, but then it's not necessarily that always every breakout or every breakdown will work out well. So we have to understand this from a trader's perspective, because when we look at things from a trader's perspective, we have to be very much probabilistic in nature in terms of our thinking. There is nothing called certainty in the mind of a trader. He would look at every trade, every situation, every forecast with a pinch of salt, and he would be like open for any kind of false moves. So that's what I'm trying to say. So not all moves are going to work in the concept of trend lines, but then they are quite effective indeed. So with this, I would come to the end of this presentation today. And in the next webinar, we will actually look at the real chart patterns. We will be discussing more in detail about the patterns regarding the triangles or the wedges that we discussed, and that would actually be in sync with what we discussed today, because that is the next logical thing that you can easily learn once you have understood the concept of trend lines. Patterns are just a natural outcome of that, and it is very much easy to implement them as well. So I hope that you enjoyed today's session, and we will expect you to come back in our next video, which will be shared soon. Thank you so much.